Hello, BSmart viewers. Welcome back to another engaging episode of Manager's Mantra, where we connect with industry leaders who are shaping the future of business management. Today, we are excited to have Richa Sawhney, Partner Tax, Grant Thornton Bharat. A chartered accountant with about 3 decades of experience in tax and regulatory matters, Richa has been associated with other Big Fours for about 16 years. She has been actively involved in monitoring, analyzing key tax policy developments, and making representations to the concerned authorities. She has developed position papers on emerging tax issues, thought leadership publications on policy developments such as GAAR India Tax Guides, Annual Budget Analysis Reports, and Doing Business in India reports. So, without waiting further, let's jump right into this insightful discussion. Hi, Richa. Thank you so much. A very good afternoon and a very warm welcome to this new session of Manager's Mantra. I'm sure this will be a very insightful session and the viewers will just love this session.
Thank you, Abhishek, for having me here.
So, without keeping you wait, I'll start straight away with the questions and we'll discuss on the questions. So, the first question, that we have for you is that about the new Tax Act that is getting operationalized from 1st April this year. How is it different from the old act? And what are the key focus areas of this year's budget as far as the direct taxes are concerned? And probably we would also like to know our B School graduates that we have with us uh, uh, tied up with our app, with our platform. They would also be very willing to know that, why is it important for them uh, to know about this acts to be an expert in business strategy or corporate finance.
Right. So, the new Income Tax Act, it's essentially an outcome of the government's effort to make our taxation laws simple to understand and easy to comply with. Now, if we were to look at our older act, it has been there for about 6 decades now. There have been changes which have been done in a piecemeal manner. Therefore, it becomes sort of a patchy piece of legislation. It's become long and complicated. So the idea when these changes were being contemplated was to simplify the law. So what has been done when this new law has been drafted is simple language has been used, technical jargon has been removed. The old and obsolete provisions they have been removed. Which means that there's a sizable reduction in the number of sections, the number of pages. There is use of tables, notes, and formulas, and there is grouping of similar provisions so that there is ease of navigation and administration. Post this act, now the rules have also been introduced. They've been put in public domain for comments, seeking comments from the stakeholders. And they carry forward the same theme of simplification and ease of compliance. Again, reduced to almost half of the earlier rules, and the forms have also now been introduced. There's a complete revamp of how the forms look. They have been redesigned. These are smart forms. They carry pre-filling facility. Most of the data will be picked up from other sources which are already available with the government. And there will be automated reconciliations. So in nutshell, what it means is that there will be a lesser mistakes that people do when they fill these forms. So all in all, this entire exercise of the new Income Tax Act, it is to ensure that, we have a taxation law which is modern and which is more in tune with times. So this is in a sense what the new Income Tax Act means. Now coming on to the key changes which have been brought about by the Finance Bill 2026, I would basically like to talk about four key areas. One is, of course, the stability in tax rates and ease of compliance. So there's no major rejig as far as the tax rates are concerned. Secondly, there is a lot of work done to rationalize the penalty and prosecution provisions. The decriminalization, a lot of offenses have been decriminalized, and this is done after the recommendations of Niti Aayog, which said that there is too much of reliance on prosecution, and there's disproportionate punishment that you give for offenses. So those recommendations have been incorporated. There is an avenue of early closure of disputes which the area has been expanded. Now it is available for misreporting cases, which is a slightly graver offense. So therefore, it will help unclog the system of all the disputes that get, stuck at various levels. The third important thing is that government data showed that only 58% of the companies have moved to the new tax regime. And one of the key factors which was holding them back was the MAT credit. So this MAT credit is now being made available under the new regime. And for those who want to continue with the old regime, this MAT will become a final tax liability and there's no more accumulation which is happening. So this is a gentle nudge to move to a more simpler regime for companies. And I think lastly, there's a lot of work, a lot of provisions which help in attracting global businesses to India. The transfer pricing related changes which provide safe harbor to a wider set of companies. Then, the provisions relating to data center, foreign companies getting a tax holiday till 2047 if they procure these services from Indian certified data centers. Uh, I think these are commendable provisions. We've also see provisions relating to increase in competitiveness of the IFSC. The tax holiday, it's been increased to now 20 years from the existing the existing provisions, and you can claim it under in a block of 25 years. And post that, the business income will be taxable at 15%. So all in all, we see a major thrust for rationalization and tax certainty, which I think will help a lot as far as positioning India as a global hub for data centers, for GCCs, and attracting a lot of foreign investment. Now, coming on to your last question on the MBA students, how all these impact. So, see, every key business decision has a tax outcome related to it. Now, be it your the funding options that you're examining, your investment decisions, your cross-border expansion, the choice of business model, all these will have a tax consequence attached to it. Now, while making these business decisions, it is important to factor these in. While tax obviously will not be a sole factor that you need to consider, but in many cases, it can be one of the critical factors. So it's important, therefore, for MBA students to be aware of how taxation laws are evolving, how judiciary is interpreting them, and of course, if there are clearer and predictable tax rules, it means that it will strengthen their decision making in the corporate world. And that is where the new Income Tax Act is leading us to. It's leading us to simplicity, predictability, and ease of compliance. And therefore, it's important for all the students to be aware of these changes.
Thank you so much. Thank you. So, speaking about the individual taxation part, do you think that the government is planning to withdraw the old tax regime for individual taxpayers, of course, and given that there is no change in it even this year?
So there is no formal communication. There's no formal sunset date that they have kind of put that down. And the new tax regime, however, it continues to be the default tax regime. But of course, there is an option. For salaried individuals, they can opt and see and decide for themselves on a year-on-year basis, and lesser flexibility, of course, for business people. But if we were to see the data that has been released by the government, even before the slab rate rejig that happened last year, about 72% of the taxpayer had already moved towards the new tax regime. Post this rejig, where people up to 12 lakh of income are not paying any taxes, uh, the current data shows around 88% have already moved. So the idea was that probably, if you continue making changes in the new tax regime, the older tax regime will lose its sheen, and they will, automatically it will be more attractive to taxpayers and they will move towards it. The FM in various occasions has pointed out that the old tax regime has become difficult to comply with due to large number of exemptions and deductions. And the newer regime, which is simpler because you don't have too much of paperwork, you don't have to store that paper, the deductions, the claims, the proofs of claims, the tax officers, it's easy for them to verify and clear your cases in a quicker manner. That was supposed to be the way going forward. But there is a surprise now. With the new rules coming in, we see that there is the limit of a large number of allowances has been hiked, and there's a significant hike in many cases. And the HRA, the higher HRA benefit, which was earlier available in 4 metro cities, has been expanded to include Pune, Hyderabad, Ahmedabad, and Bengaluru. Now, all these are mainly available in the old tax regime. So it seems that we can't really write off the old tax regime right now. And for salaried taxpayers, it may be worthwhile to examine again afresh basis the components of their salary of what works best for him. So I think it's not that the old tax regime is going to go away very soon.
Get it. Thank you. So, what are some of the significant changes to the tax collected at source on the liberalized remittance scheme? And, it would be interesting to know that how do they help taxpayers? Can this reduce the tax burden on, say, education and the medical expenses?
So, first of all, let me just talk about what is the rationale of having TCS on LRS. See, the idea is to strengthen the financial oversight, to curb the potential misuse of your foreign remittance. Now, overseas spending by Indians, we've seen a sharp growth in the past, in fact, post the COVID era. Government noticed that a major chunk of the foreign exchange is being used on for foreign travel. 58% to be more precise is the recent data, which is up from 50% just a couple of years back. Then the other significant amount is being spent on education, around 12.2% a couple of years back, but due to some geopolitical reasons, which we're all aware of, it's come down to 9.9% in the recent past. And then the maintenance of close relatives. So major chunk was being spent on that. But there are certain areas which was, it was evident that there were cases where people were not filing tax returns showing lower income, but there is this major spend which is happening on the LRS front. There's a lot of foreign travel happening. A lot of other remittances happening. So there was a need felt to track this, to create a transaction trail. So that was the intent with which these provisions were introduced. Now this TCS collected, it's not a final liability. It is creditable against your final tax outgo for the year. So with this backdrop, these changes were introduced. Now, what has been done in the current budget is for medical and education. The rate of 5% has been reduced to 2%, and this is applicable post the threshold of 10 lakhs. So once you've made that remittance, then it becomes applicable. If you are remitting, the students who are remitting this money for education from their loans which have been taken, there is no TCS involved. Now, what it does is, and how it helps the taxpayer is that the families who were supporting these children who go abroad to study, or for the medical expenses, they were facing a lot of cash crunch. There were liquidity challenges they were facing because of this upfront collection of tax. So when this the rate reduces, it helps them with their cash flows, and the challenges that they were facing, they kind of reduce to some extent. Now, coming on to the tours, the foreign travel piece of it, again, here the rate has been reduced to 2% from the existing 5% and 20%, and the threshold has been removed. So, irrespective of the quantum, this is 2%. This change has been done to take care of the demands of the Indian tour operators, who have been highlighting that, because of these upfront collection of taxes and the GST part of things, they are losing their competitiveness as compared to the foreign tour operators. They are losing their business. So just to take care of their demands, this has been done, and of course it also takes care of those people who want to go abroad and travel. So the upfront blockages of cash, they are kind of not taken care of by the reduction in the rates.
Thank you so much, Richa. So, Richa, just a bit earlier, the earlier part of the conversation, you mentioned about the safe harbor rules and the APAs. Can you please simplify the changes in the safe harbor rules or advance price agreements in this budget, and how does it impact businesses?
So there's been a major expansion of Safe Harbor. All the IT related services, they have been grouped in one category. So and there's a Safe Harbor of 15.5%. Now, earlier there was a lot of disputes around how you're going to categorize them. There was the category of IT, ITS, KPO, contract R&D, and you had a range of 17 to 24%. So all these classification disputes that were happening, they are now taken care of, which is a big relief to taxpayers. Next, the eligibility threshold has been raised from 300 crores to 2000 crores, which means that, the framework is now accessible even to the larger companies. There's much more companies can avail the benefit. Now, the entire approval process has been automated, and there's a 5 year period. You can get a 5 year kind of certainty, which was not available earlier. As far as companies beyond the threshold of 2000 crores is concerned, the APA route is available to them. Here again, the government is committed that, this will be fast track now. What was done earlier, maybe taking 3 to 4 years, you could now get it done within 2 years time frame. So all in all, and of course, there's, the 15% margin, which they have now put forth for captive data centers, and 2% margin for the component warehousing. So all these safe harbors, what they do is that, it brings predictability, tax certainty, reduces the disputes that are likely to crop up, and that way they support businesses going forward.
Our viewers would also love to know if you could also explain the changes in the tax regime in the global capability centers.
So, as far as global capability centers are concerned, it's evident it's now one of the most exciting business ecosystems. If we look at the data that has been released by the government, around 1,800 GCCs employing 2 million people, contributing around 1.6% of the GDP. So, it was essential, I think, for the government also to cater to what their demands have been. And a lot of those demands have actually been met in this budget. We just talked about the expansion of safe harbors, the grouping of activities together for the IT services so that a wider variety of activities can take place. The eligibility thresholds increase, the automation in process, 5 year margin availability, fast track APA. All these things put together help, with the expansion of GCCs. And, the other aspect that goes very well with this once it is implemented on the ground level is the national GCC framework. So there was a discussion about it in 2025, and once this is implemented on the ground level, what it means is that there will be an expansion into tier 2 cities, tier 3 cities. There will be not a concentration in the metro cities, which what it implies again is that there's a reduction in cost, both in terms of employees and the infrastructure, and the evenly spreading out of high value jobs throughout the country. So all these things put together, I think, will help the government achieve the target of about 3.5% of GDP through coming through the GCCs. So a lot of these changes going forward, I think, give opportunity for India to position itself as a major GCC hub going forward with the conducive laws and the nurturing overall regulatory framework.
Thank you so much. Richa, as you know, a lot of our viewers are the students, and a lot of them would love to get into tax advisory roles. And who better than you to, actually ask and actually know from that, what are the probably what are the skills they should develop, and what are the different traits that you look for where when you hire people in tax advisory roles? I mean, somebody you think, how can someone, just stand out while interviewing for this kind of roles?
Well, this may seem like a big list, but for advisory roles, typically what we look at is a blend of of strong technical tax technical knowledge and, of course, commercial awareness, the ability to communicate the complex concepts with clarity in a simple manner. Basic understanding of allied laws is also very important because what we need to give to our clients is holistic, well thought through advice and solutions. Then, of course, one critical element is the strong research capabilities, the analytical skills, and an eye for detail. That's really very important as far as taxation advisory goes. And then tax is an area where you need to learn and unlearn on a very regular basis. You have judicial developments, interpreting laws, you have budget every year making significant changes. So, an ideal candidate for us would be somebody who shows a willingness for continuous learning because we are living in a very fast changing tax and regulatory environment. So, that becomes one of a very critical parameter that we kind of look at.
Thank you so much, Richa. So, with that question, we come to the end of the conversation. It was amazing to have you, and I'm sure viewers would just love this session. There is so much to learn from this session and from your, insightful updates. We look forward to staying in touch with you and have you again in another session of Be Smart in future. Thank you so much.
Thank you so much.
That's a wrap on this episode of Manager's Mantra. Thank you, Richa, for sharing your insights on the tax landscape in India and how we are looking at it after the union budget. Be Smart viewers, we hope you found this conversation helpful. Share your thoughts with us at bsmart.edit@bsmail.in. Follow us on LinkedIn and Instagram for more such insightful and inspiring content. Until next time, keep learning, keep growing.